Hey folks, welcome back. This trading course called Q-13 or 13 is about the Gailani spider web strategy. This is a very special strategy, and you cannot find any other places, as this has been developed by me, Azad Gailani. Once you have used this strategy in your ordering, your order book then will look something like this image that I am is shown here, and this is actually my ordering defined by this strategy. And once that strategy is applied, so the chart is showing all my orders, and since it looks like a spider web, I call that a spider web. Okay, so if you also place your orders according to this strategy, your order book will look something like this. Okay. Please, before we continue, read our disclaimer. Once you have continued watching our video, that it means that you have agreed with the terms and conditions offered in this disclaimer. Thank you so much. Okay, before we go into the detail for this Gailani's spider web strategy, I would like to outline or mention some very specific features about this strategy. The first features is about the risk to reward ratio. The risk reward ratio that is offered by this strategy is more than 1 to 20, and that is huge. Normally all supercomputer on a trading floor or a professional, they are targeting something like 1 to 1.2 or 1.3 or 1.5. The maximum is 1.5. In our case, it's about 1 to 20. That is huge number. That is amazing number. If you can, that means basically for each dollar that you are risking to lose, you are making $20. So that is very big number. I know you won't believe that right now, but once you have seen all the details, you will believe that is true. That is the reality, and that is the main feature with the Gailani's spider web strategy. Okay. So the other important feature with this strategy is that no matter how much you are investing, how big is your investment in a trade or in asset, you will never ever risk less than 1% of your investment. So that is again an excellent risk management feature or opportunity. Okay. That you cannot lose less than 1% of whatever you invest in your trading. Okay. So the other good feature with this strategy is that it works for all type of trading, whether you are a swing trader, day trader, position trader, whatever. It works for all type of trading, and it also works for all the market except bond and rate market. So it works very well with the stock market, works perfect with forex, commodities, and so crypto. So these works, and also is perfect strategy for leverage trading. If you are trading like CFDs, futures, or spread betting, whatever, all these derivatives or leverage trading, this strategy is the perfect one. For example, sometimes when I trade on Binance exchange for crypto, I start with 3x with using this strategy, then it goes up to 200x, but still I lose only for 3x. My risk still is 3x, rather is not 200x. This is a perfect strategy for leveraging. So you start with 3x, and then you add on another 3 as the price moves. Okay, but all the time you are just risking 3x. Okay, so it works in all time frames. Okay, it has no problem with the time frames. Okay, let's start what is this actually, this strategy all is about. Okay, here we go through one example, and through that example I hopefully we can outline, we will manage to describe you and get you the picture of how this strategy is gonna work and how it will help you. Okay, let's assume we have an asset, we are targeting an asset, we are buying something that has the price like this. You know, for simplicity I just make this price just increasing, but in reality it's in reality is a lot of movement here, and a lot of other prices between the 100 to 110, but just for the simplicity I just had the even numbers here. Okay, so let's say that asset have this price, and then we have the, let's assume that it's having this price action, this price movement. Okay, and then so before, when the price was here, so we decide, okay, to enter at 100. Okay, at 100 we place an order, so we call it order number 1. Okay, with that order we invest $100. Okay, with risking $10. So that means basically our stop loss will be set on 90. So 10 minus 100, that's 90. One thing that is required, you have to be careful with this strategy to work for you perfectly. You need to define your stop loss very well, because the whole strategy movement, the whole strategy is based your stop loss. Okay, that stop loss that is driving these strategy. So stop loss is number 1 that you have to identify that one before you are entering and as entering a trade. Once you enter that trade, you will use that stop loss to all the way to in this strategy. Okay, so in that case, in this example, our stop loss value is $10. Okay, $10. 100 minus 10 is 90. So the stop loss here, it means that if it reach here, we will lose $10. And then let's say we put a target. Normally for this strategy, the other requirement for this strategy is that you put a target far away. Okay, so we place a target here on 190. So now we have placed the order number 1, and that target will be the target for the whole order book, the whole strategy. So you are not going to have a different target for different orders. So that is the main target. That's why we put that far away. Okay, as a target. So the basically the first order, we place the first order, we place our stop loss, and we place the target. So this is the 3 normal things that you're going to do for one order, and that is then we will look at that, how the price is moving. And then the price moves, the price reached to 110. That is how much the price has gone up. The price has gone up equal the stop loss value. The stop loss value was 10 because it went up that, and then we place another order here. Once we place another order number 2 here, again we this time we have invested in total 100 here and 110 here, 200, but this time we will use the stop loss here. So what will happen, okay, this stop loss, we remove that stop loss, we put a new stop loss which is for both order number 1 and number 2, which is 100. Which basically means that if it drops from here, what will happen, still you will just lose 100 despite you have double your investment here, because here for order number 1 you are on break even, right? You are break even because the stop loss is not right here, is not here on 90. Okay, then we wait when we look at the price, what will happen with the price. The price goes up, and then next target for ordering is then the current entry for order number 2 plus the stop loss value. Stop loss value was 10, so 110 plus 10, it becomes 120. We look at the price comes to 120 to place the next order, and then the price reached that, bang. Okay, once the price reached that, okay, we have the price, we have the target, exactly the same target, we don't touch that target. Okay, we have the price here, the order number 3 here, and now is turn now we have to place the stop loss for this one. So what will happen, we will remove this stop loss and define a new stop loss. Okay, we remove that one, and we now move the stop loss here as a trailing stop loss. So this stop loss is for order 1, 2, 3. So that is for 1, 2, 3. So what will happen here, at the moment we have increased our investment to from 100 to 330, but still we are just risking $10 here. Why? Because if it happens from here to drop, and then we will lose $10 here, and then this one is break even, and this one is making $10. So basically from order number 3 you are losing no money, absolutely no money. Can you believe it? So after order number 3, you're tripling your investment, but your risk is 0. Why? Because if it happens, it drops here, you lose $10 here. This one is break even 0, and this one is making $10. So $10 plus minus $10 is 0. So basically at this stage we have managed to get 0 risk. Amazing. It's just amazing, you can do that. So now we will look at the target and see if we will add the stop loss value was 10 plus 120, the entry point of this order number 3. The entry point of order number 3 is 120 plus 100 plus 10. The stop loss is 130. So we look at the 130 this time, if the price reach 130 or not. Once the price reach 130, we place another order called order number 4. Okay, this time we have invested $460 in this asset, but we are risking only $10, because until here we were risking we are risking no money until here. Okay, so what will happen here, once we have placed our order number 10, then the next step is going to the stop loss. Okay, we remove this stop loss here and we place the new stop loss. Okay, that new stop loss, what is that? This stop loss is now at 120, and that is for order number 1, number 2, number 3, number 4. Okay, so number 3, number 2, number 4, we had that 0 if it's something happened. Now we have that again 0. Why? Because this one goes up again 10. So you have basically zero risk again here, despite you have spent it 460 here. Okay, so we again here we are the 100. We look at the entry point here for this order number 4. The entry point for order number 4 is 130 plus our defined stop loss value, which was $10. So plus $10, it becomes $140. So we look at we look at 140. When the price reach 140, we place another order, and then it reached, we place order number 5. And once we do that, what will happen, we have now invested $600 with $10 risk again. Okay, so once we have placed that order, the target again is the same, because we said that we will place the target far away. Okay, the target we will not touch it, and then this time we have all these 5 orders has been executed, and then next step is to delete as we order, we have to update our stop loss. So we remove this stop loss, we make again a stop loss to the previous order number 4. As you place one order, a stop loss goes to the next order, and the entry point, it should be equal the entry point of previous one. So the order we got here is number 4. So the stop loss for all these orders that has been already executed, so that will be to the previous entry. The previous entry is 130, so we have 130 here. So again, so we if it do you see almost you are risking nothing here, almost nothing. It maximum is $10 that you are risking, while you have gone investment from $100 to $600 for the same asset. Okay, so now we have this in our portfolio. We have bought this asset 5 times with 5 different prices, but still, and we have increased our investment in this asset, but still we are just losing almost losing nothing. It's just $10, maximum $10 that we're gonna to lose. Okay, so what will happen here? So we will look at that again. This entry point is 140. For we will look for the next order. Next order, when it is when the entry point of the current order, executed order, plus the stop loss value. The stop loss value was 10, so 140 plus 10 is 150. We will look at 150. If the price reaches 150, we will immediately open another position. So the price reach that we place another, or we open another position, place another order. We call it order number 6. Okay, so we did that. Now we have to again to move our all stop loss for all these orders to the previous orders entry point. What is the previous orders entry point? The previous order before 6 was 5, and that entry point was 140. So what we will do, we delete this stop loss, we update with the stop loss with 140. Okay, so look at that, and now we have increased our investment. We have increased double, triple, multiple, exposure on our what is called our profit. Okay, with the same risk. Okay, now we will see how the price is moving, and then we will see that we are here before it comes down here. We are here someplace. So we look at the entry for order number 6. The entry was 150. We plus that with the defined stop loss value, which was $10, so it's 160. So we look at that 160. When it reached that, we look at, yes, it reached it here. It reached that, we place another order here, and we call it order number 7. Okay, that order number 7, now our investment has increased from 100 to 910 for this asset, but we are still losing $10. Okay, so once we have placed order number 7 and that has gone through, executed, then we update our stop loss to the previous entry point. Previous order entry point was 150, so we move all our stop loss for all these assets to the same level. So we remove this one, we update that to the 150. So we have the stop loss for order number 1, 2, 3, 4, 5, 6, 7, 100. For all of them is 150. Okay, so now at this time we are here. Don't look at here, because this is different time. We are not here. Okay, so at this time, we have updated our stop loss. We have executed our order. We got the order and we have the target. Now what we do again, we look at the current entry. What is the current entry? The current entry is 160 for the order number 7, plus the stop loss value. The stop loss value was 10, so 160 plus 10 is 170. So the price here reached 170. Perfect. We open another, we place another order, we get that 170. Okay, now it's turn for what? Now it's turn for our stop loss to be moved. Okay, we move the stop loss to the previous entry point, orders entry point. What is the previous orders? Is number 7. What is the entry point? Is 160. So we delete this 150, we place 160 here. Perfect, just perfect. You look how it is working. Okay, now we go, now we are there. Once we are there, so we are looking to get the 180. We are not getting to 180. The price drops, comes here, bang, the price hits our stop loss, because it dropped, it hit our stop loss. What we did here, we invested $1,080 with only 10 pound risk. And now we will look at that, how much we make of this, when the stop loss gets. So we risk only, out of this 1080, we risk only 10. No matter what was happening, we risked only $10. Can you imagine how perfect this is? Okay, so what happened now? Okay, we place all our order, 1 2 3 4 5 6 7 8, and then from 8 we were just trying to get 180 in, but it did not reach. It dropped the price and it hit our stop loss here at 160. Okay, so what happened? Yes, let's see what actually happened. Okay, for the first order we make $60. For the second order, we make $50. For the third order, we make $40. For the fifth order, we make $30. For the sixth order, we make $20. For the seventh, we make sorry, for the I read it here. So first 1 2 3 4 5 6. For order 6 we make $10. For order 7 we make 0. For order 10, for order 8 we lost $10. We lost $10. So if you add this all together and subtract that from $10, so you make $200 here. $200. So you basically make $200 of risking only $10. Risking $10. What that means? That basically give you a risk to reward ratio of 1 to 20. 1 to 20 as a, and no matter how much, we had 1,800. If the price has gone, we have just gone up with that. And no matter how much you play, you invest that, if you follow this strategy, you will always lose less than 1% of your investment. Always that is restricted to less than 1%, not even 1%, less than a percentage. Okay, so this is extremely important. Look at that, how beautiful it has helped. So just try this one and see how it will help you, how it will improve your investment, and how what kind of power that will give you to your risk management strategy. This is a proven strategy. This I have been using for the leverages. As I said, for the leverages I go from 3x up to 200, sometimes 300, but still I am just losing less than 1%. But on the other side, I make a huge money because it's 300. It's just moving. But with this spider web strategy, is just everything so perfect. Everything is guarded. Everything is so secured. Is just because of so excellent risk management feature that this strategy has. Okay, so let's see what is the advantages of spider web strategy. There are some very, very good advantages I will just mention here that I think you will see. You already see that the huge advantages have that one, but maybe some of them that you will not think about that. Okay, I wanted to mention them. Okay, one of them that is never add to the losing. It stop you to adding to a losing trade. Okay, it stop you adding the category. Instead it help you to only add to the winning trade, because that is the main thing, that is the main strategy, that is a professional trader does. Okay, and the other things is that it help you can invest more with much less risk. You can invest how much you wanna, you are risking. Just your risk, that your risk is defined. Exactly specifically how much your risk it is less than 1%. Okay, so it maximize your profit. You saw that we started with 100, we make 200. So basically with 100 we risked $10, exactly the same $10. So what we did, we doubled our investment. We doubled our 100, because don't think about that 1,000, because we had all the way risk only $10. Only $10. That means basically in reality you have just invest $100, and out of that $100 you make $200. So it's almost 200%. Okay. It has the best risk management. It's obvious that you have that systematic work makes you feel professional and strong. This is reality. Once you are working like this, systematic and well organized and well defined and by plan, good plan, and this will give you the feeling, professional feeling, and give you a strong feeling, and it will help you to have a confidence, self-confidence, or confidence in your trading. This is very, very important, because basically you enter trades in a systematic way, in an organized way. It's not just something that has been driven by your emotions or other factors. Okay, it controls your emotion and calms you down. That's perfect. Because why? Because it calms you down and control your emotion, because you are thinking about this. Okay, now is my entry point plus the stop loss. Now I will wait for the next move, next price. When that price reach, I will enter that. So that basically make you to calm down, to make you to control your emotion. And then once you see that, okay, when you move from one stop loss to break even, you see that you have just started to go, things has started going in your favor. If it goes the opposite way, so of course you have lost $10. So this is how it is. It stops you trading out of excitement. I think that goes part to the number 7 here. And then prevent you from taking revenge deals. That is why, because you are not losing that much. Because you are not losing that much, it prevents you. It prevents you from from taking revenge, from the market. Just because you have lost a lot of money, you wanted to fight against the market and try to take revenge, and that is too risky. But this one is gonna because you are not losing too much money. It's okay for you. It's controlling your emotions, and you are not afraid, and then that basically prevents you from taking revenge deals. Okay, it stops you looking to recoup your losses. In another, it is going back to the number 9 exactly. Is because you are not your losses are not so big, and on the contrary, on the other side, your profit are huge. Okay. So create a great risk to reward ratio, which I show you. The minimum is 1 to 20. That is very, very good. Make you to focus on what is in your control, instead of focusing on something that is not in your control. That helps you to better control your stop losses. Yeah, because the main factor of this strategy is how you define your stop loss. Once you define your stop loss, that is the main thing that you're using for defining the entry points, not the technical analysis. You are not going to go with the technical analysis for finding the entry point. You just have find your entry point with the help of technical analysis or other things, and then you use that stop loss then to define all other orders until your stop loss is hit. You just carry on until your stop loss is hit. Okay. So the best way is to lock the best way is to lock the profit, save the profit with this one. It already is obvious in these things. Okay. Okay, gentlemen, again, please read our disclaimer. Thank you for being with me. I hope that this strategy will help you. I hope that you will back test this strategy and test it, especially with leverage and all things that high risk. Okay, so wish you good luck. Take care.